traders, this is an introduction to trade management from Trade Oracle Group. Hopefully you're a part of our Discord channel. You're participating with the pro traders. You're using flow and phase to give you an edge in your trading. But what is probably second only to finding and identifying good trades is how you manage those trades. So this introduction to trade management is extraordinarily important. That's why we've cut it into 4 or 5 parts, so that you can look at each one and take notes as you need. All of this stuff is reiterated in our live chat room on the Discord channel as well. If you ever have questions, feel free to email. And of course, join us in the chat room and ask questions anytime you'd like. This is all part of the tools for the trade system. Let's get started. A quick trade management review. With trends, you can talk about trends in a number of different ways, but we stick to really 3 kinds of trends. And we're going to talk about how to manage each type of the trend and how some of these other things affect the way that we trade depending on the trend. In the second part, you're going to learn about the time in the trade. Whether you trade for 5 minutes or an hour or a day or a week's determines in part what kind of risk you take, how much money you expect to make on those trades, and what kind of volatility you might have, and so on and so forth. So it's really different when you're trading for 5 or 15 minutes versus hours. And that's what we're going to focus on mostly in part 2, time and trade. The third section is going to be trade size. And that's probably one of the most important things that level 3 and level 4 traders really use to get big profits, and also to get where their losses are not very large. They're able to fix trades when you learn the secrets to how to repair trades and how to slowly carve out profits of a trade that might otherwise be a losing trade. We're going to talk about that in trade size. The next part will be on entry and exit, how you enter and how you exit, to include scaling in and scaling out of trades. Then we're going to try to tie all of that together in the summary section, where we talk about creating this dynamic system, which each section is kind of justified inside of that. And then you can modify it or tweak it depending on your trading style and your personality, and your bank account. And we can go from there. When you leave, though, when you've gone through all of this and you've participated in the Trade Oracle Group for a while, you should have a system that comes to be you. It is part of your personality. It's just the way that you trade. And when you get that down pat, you're bound to be successful. Today, we're going to talk just a little bit about trends, the market trends for traders. Now, everything is built on price action, and all of that combined creates trends, right? There's the primary trend, which is generally the longer term trend, either bullish, going up or down, being bearish, or sideways. Inside of those primary trends, they can actually have different measures of volatility, right? You can have a primary trend that's going up for minutes or days or weeks, and that primary trend can be steadily trickling up, or it can be bouncing way up, bouncing way down, bouncing way up, bouncing way down. So a primary trend is talking about, when we look at a primary trend, there's questions to be asked about that primary trend. What's the angle of attack of that primary trend? Is it slowly moving up, or is it broken up quickly and it's turned, and the angle of attack, the amplitude, the rate at which it's going up in price is steeper than it was perhaps before, or it's changing its amplitude. It was slowly going up. Now it's increasing in amplitude, or it's been going up quickly. Now it's flattened out and it's still setting higher highs and higher lows, but it's going at a lower rate of improvement than it was before. All of those things are key to understand in a primary trend. The second is a counter trend. It's a smaller trend, typically inside of that more dominant trend. And we trade differently inside of a counter trend, right? On a primary trend, if I see something that's strongly moving up and it comes back to a support level, even an angular support level, I trade full on. So I may trade, if I trade 10 lots, I'll trade 10 lots. If I trade 10 contracts, I trade 10 contracts, whatever the case may be. If it's a counter trend inside of that same move, though, and I go, well, it moves way up and then it comes back 50%, and it goes up $5 and it comes back, $250, there's still money to be made in that $250, but you're going against the longer term, bigger pressure in the market by trading the counter trend. So what do we do for that? One is we tighten up where we enter and exit. We'll talk more about that later, but we also reduce the size of what we trade. So depending on what kind of trend we're trading tells us what size we should trade. So if I'm normally a 10 lot trader, I would trade maybe 3 on a counter trend. If I trade 3, I would trade 1. The third is a changing trend. And this is a trend where we're expecting the trend to actually come back. It's setting higher highs and higher lows, or lower highs and lower lows. But then it bounces around maybe, and then it goes and does it again. But it's in a place where it's starting to turn. A changing trend, there's a lot of money to be made inside of that, especially if it's sideways and it goes back and forth within certain bands. Where we find real opportunity with changing trends is in the use of flow. Flow tells us that you've got all of these pressure points and different times series of the market that are all working together, and it's going to change this trend, and it's going to take off like a rocket. When that happens, then and you're able to identify those trades and see where that may happen, it's a great way to trade. Still, however, although all the exceptions, you still start off small. You still trade smaller. If you're 10 lot trader, you trade 3. If you're 3 lot trader, you trade 1. You trade smaller, and you give it a chance to prove that it's changing trend. And then when it comes back that first time, then you can get large again. But we trade differently based on the trend: primary, counter, or changing trend. It's also important to recognize that different patterns carry different confidence intervals. Different patterns carry differing confidence intervals. We'll talk a little bit more about it later, and I don't want you to memorize all these percentages, but think of it, or just understand the basics, right? That patterns are an expression of human psychology. They're just expressed by way of price action. The chart, the movement of stocks and futures and options forex across time, is really the expression of human psychology. Well, Richard, I thought 40 to 60% of the market was automated systems. Very true. Automated systems are built by humans, and they also trade based on patterns, which are the reflection of human psychology. So all of it is still built on some of that. It may get bouncier. It may have more volatility in some areas because of all of these newfangled AI systems and other things that are in there. But flow was one of the first, and I think the best. We see those big patterns across millions of data points that we've been watching, with some of our data going back literally 100 years. And we find every common waveform, every common pattern, and what that pattern predicts in the past, what it's predicted then, and what it should be predicting now. And it gives you the confidence interval in that prediction as well. So being able to see the future in front of you by that forward expected movement gives you another little bit of advantage. When you use that and you understand good risk management and you understand patterns, if you see a head and shoulders pattern and you know that it's 67% likely, or even just that it's more likely to continue moving, when it has a big move up, it comes down, tries to make a higher high, and it does it, then it tries to do it again and it fails, that's the beginning of a head and shoulders. Then it's 67% likely to fail and go through and repeat what happened on the other side. Breakouts and accelerated crossovers, when you have an 8 and a 21, or whatever you use, 11 and a 30, a 20 and a 50, EMA crossover, exponential moving averages, simple moving averages. When those moving averages cross and there's a big move, and that, what is a big move? Typically it's 1.5 to 2 times the size. So a bar that's a 5-minute bar, it means that bar is 1.5 to 2 times the size of the average 3 bars before it. It has that big move out, and then it comes back. When it comes back to where those lines have just about crossed over, and it comes back to one of those moving averages, buying in that space, if it broke up, or shorting in that space if it went down, you have about a 72% likelihood that it's going to continue in that direction. Double, triple tops and bottoms, when you have things that hit the top, and they keep falling apart, they're 73% likely to continue moving down in that direction. There's institutional selling or institutional buying that's created a support or resistance level there. Rounding tops and bottoms are kind of the same. The difference is in rounding tops and bottoms, where you see something going up and it slows, and it looks like it's going to roll over, and it kind of goes flat for a while. Sometimes we don't know how long it's going to stay flat. And if you normally are trading, this is why the time in the trade and some of our next session is important. If a rounding top is not something that a day trader will normally trade as much, because you may end up thinking it's going to last for 3 5-minute bars, and it lasts for 30 5-minute bars before it finally breaks. But it does give us high confidence to trade in those, because they're about 65% more likely to complete that turn and to go in the other direction. So in each one of these, we have an advantage with flow. Flow tells us that in these price charts, we have pressure building up and it's likely to pop out. So even if we have to wait a little while, it should be worth it. If we see a big move predicted in flow, up or down, trading in that direction typically is worth the time to wait, and learning that kind of patience pays off. And you'll find out that as you get to be a larger and larger size trader, that you're going to have to be patient for some of the bigger wins. The type of trend that we trade affects your decision on trade size as well. I'm just going to make it really simple. And there's a lot of other patterns, and there's mixes of patterns, right? There's horizontal and angular support and resistance combined with a pattern change, combined with flow. When we have all of those together, telling us what type of trend we have, it will tell us what our trade size should be. We're very open about whether we're trading small or whether trading large. We're trading half lots or trading full lots. And a half lot for some person may be one because they trade two when they're bigger. A half lot for others may be 50 option contracts instead of 100 contracts. It doesn't matter. We don't need to talk about contract size, but we need to talk about the percentage of what we normally trade as full size versus smaller. We typically only trade larger when it's consistent with a primary trend, or it's been in like a changing trend, and now we've seen a higher high and a higher low. And then it comes back to that support level on that uptrend. Then we go from being small to being large. I may have had 3 contracts. I normally trade 10, and I go and I add 5 or 7 more. That happens as well. But we always trade smaller if it's a secondary or counter trend. We always trade smaller if the changing trend doesn't have that higher high and higher low. And we trade smaller if it's a choppy market, just because oftentimes our expected risk is higher than what we want. And one of the great things with flow is that it's oftentimes right, but sometimes you have to go through that volatility for it to get there. And so you want to allow enough volatility to be right. So if normally you're risking 50 cents, you may want to be able to risk 75 cents or $1 to be able to make that trade. But if the trade is only making $1, then it becomes 1-to-1. So if that's the kind of trade you want to make and you think it can do well, then we typically don't trade things that are less than a 1.5-to-1 reward to risk. But if you have high confidence because of flow and because of patterns, you may want to take that trade, but you trade smaller, right? That's the difference. So that kind of wraps up what we want to talk about with trend. It's important to recognize that different patterns carry different confidence intervals. It's important to know that we adjust size based on the kinds of trends that we have. And you're going to hear our pro traders talk about patterns and trade size when you're in the Discord trading with folks. So I hope that you'll join us in one of those channels. If not, if you are subscribing to our alerts, you're going to start learning more and more about how we trade and build in and out of trades. And you'll find that we have a lot more winning trades than most folks because we manage them differently. And managing makes a lot of difference. So thank you for listening to this chat. And please like it and share it if you can. And we will see you in part 2.